Next, we will introduce you the method of index portfolio investing. So there are two mutual fund is very famous recently. One is index mutual fund, the other is ETF. So we will introduce the index mutual fund and ETF, these two methods of index portfolio investing. As an investor, definitely you can construct your portfolio by yourself, but there is one way. It's very easy and not time consuming. You can directly buy the mutual fund. So what's the mutual fund? Mutual fund is establish a portfolio. That portfolio is managed by some professional investment company. So all the investors, they don't need to decide which stock they want to invest. They can directly buy this mutual fund. So let's have a look. The first one is index mutual fund. For index funds, it is replicate the composition of a particular index exactly. So it is fully replicate your index. And then it will change the composition anytime the composition of the index itself is changed. So it will depend on your benchmark. If your benchmark index change the composition, your portfolio composition need to rebalance. And the last point is low trading and management expense. So compare with other active management portfolio, this index mutual fund tracking the benchmark will definitely have low trading cost and management fee. Now let's have a look at the advantage of index mutual fund. It is they provide an inexpensive way for investor to acquire a diversified portfolio. So I will give you an example. If you only have 1,000 Chinese yuan, and how can you buy 10 stocks? Of course, definitely you cannot doing that because 1,000 Chinese yuan is too small. So if you want to buy Guizhou Maotai, it is not enough money. But you can buy a mutual fund. This mutual fund can allocate your money to invest more than 10 stocks in the portfolio. So that is an inexpensive way for investor to acquire a diversified portfolio. So if you don't have this mutual fund, you cannot do any diversification effect for your portfolio. And the disadvantage for this index mutual fund is that investors can only liquidate their position at the end of the trading day. So there is no intraday trading. So what's that mean? As we know, for all the mutual fund, especially for the open-end fund, we can only buy or redeem our fund based on the price at the end of the business day. So in this case, we can buy or redeem during the day, but the price will depend on the end of the business day. And there is no intraday trading. So that means the index mutual fund, you buy or redeem that, you cannot like buy a share or sell a share in the secondary market. So there is no intraday trading. And the second one is the index mutual fund usually cannot short selling and may have unwanted tax if the fund has an foreign need to see a proportion of its holdings, thereby realizing the capital gain. So what's that mean? If the fund investor want to redeem their number of mutual fund shares, the mutual fund manager need to sell their stocks in the market and pay the cash to the investor. So in this case, if they are selling some stocks in the portfolio, definitely it will pay the capital gain tax. So this is the one of the disadvantage for index mutual fund. Now let's have a look at the second method of index portfolio investing. That's ETF, Exchange Traded Fund. The ETF is very famous recently in the market, so lots of investors, they are interested in the ETF. So let's have a look at the ETF. The significant advantage of ETF is they can bought and sold and short selling like a common stock. So this is very important. The one advantage of ETF is because they can buy and sell like a common stock, and smaller management fee and less capital gain liability. So generally speaking, ETF is a kind of open-end fund with a closed-end fund. So like a closed-end fund, it can trade like a common stock in the secondary market. But like an open-end fund, it can only buy or redeem like a mutual fund, and you can only compare buy or sell with the mutual fund company. So that's the advantage for ETF. And the disadvantage of ETF is it includes a brokerage commission. As I mentioned, if ETF could trade like a common stock, you can do like a trading stock in the secondary market. So your mutual fund firm will sell the stock for you and pay the cash to you. So they will charge the brokerage fee for you. And the other is the inability to reinvest dividend. For the ETF, all the dividend will pay you as a cash, but for the index mutual fund, they can directly reinvest the dividend for you. So that's the difference between ETF and indexed mutual fund. Now let's have a look. I have summarized all the difference between ETF and other mutual fund, especially as separate as the open-end fund and closed-end fund. As I mentioned before, the ETF can get all the benefit from open-end fund and closed-end fund, so we need to compare them together. Now let's have a look for the open-end fund. What's the similarity and the difference between open-end fund and ETF? For the similar, both of ETF and open-end fund, they can be buy or redeem. If you buy any mutual fund in the market, you know that you can buy or redeem like a mutual fund. And the difference between the open-end fund and ETF is because the ETF, they can trade at intraday price. So if you are doing the ETF and you buy this ETF like stock in your phone software, you can sell your ETF at any time in the market. And the second difference is because the ETF, they charge large brokerage costs compared with other open-end fund. For open-end fund, all the investors, they can buy or redeem their mutual fund shares only at the end of the business day. So the price they buy or redeem their shares is exactly the same. However, for ETF, if you trade it in the secondary market, you can trade like stock. So the price is different for different investors. So the brokerage cost is much higher compared with the open-end fund. And for the ETF, it will receive the dividend. As I mentioned before, all the investors for ETF receive the cash dividend. But for the open-end fund, they can reinvest. The last one is less capital gain liability. So what's the meaning about capital gain liability is less? Now let's have a look, think about that the ETF. If you redeem your ETF, the manager will give you a basket of stock, but not all the cash. So the fund manager, they don't need to sell all these stocks, all these ETF stocks in the market. They only give you this basket of stocks. So there is no capital gain realization. In that case, for ETF, it is less capital gain liability. If as an investor, you receive that basket of stocks and you can take all these stocks in the market and sell all these stocks. So at that time, you will be charged the capital gain tax. Now let's have a look what's the difference between ETF with the closed-end fund. As we mentioned, the ETF and closed-end fund, they both purchase and sell in the secondary market, so they can trade like a stock. But what's the difference between these two? The ETF is passive managed to match an index, so that's a very important difference between ETF and closed-end fund. ETF is passive managed to match an index. However, the closed-end fund, they can be passive or active anyway. Now let's have a look. There are lots of examples of ETF. So I will show you some famous one. The first one is based on the home market we call the broad-based index. In Chinese, we call 宽基指数. So the first one is SP 500. That is very famous. And in China, we have CSI 300, CSI 500, SSE 50. So that's 沪深300, 中证500, 上证50. So all these ETFs, they are tracking this benchmark, their market index. The second very famous in the world is iShares. So iShares is founded by BlackRock. It is considered a portfolio include different assets in your portfolio, such as emerging market stocks, fixed income, or other industries. So this is kind of famous ETFs. And the third one is the sector ETF. For sector ETF, you will consider the industrial sector, including the consumer service, industrial, technology, financial service, energy, utility, and transportation. All these sectors are depend on the mutual fund managers' expectation, so they can do any sector rotation between different sectors. And we will talk about more sector ETF later in the lecture to show you some cheap ETF or some alcohol ETF, etc., based from different sectors. Now let's have a look. I will show you some ETF in China. And the first one is market size index ETF. This is China AMC China 50 ETF. The Chinese name is 上证50 ETF. And this one is founded by Huaxia. And we can see there is the performance for this ETF. And from the performance, the pink shadow part is the best 6 months return, and the green shadow part is the worst 6 months return. So we can know that the best 6 months return is quite nearly in 2007, and the worst 6 months is in 2008. So this 2008 is because our financial crisis, credit crisis in US. And after that crisis, we can have a look at the shape for this ETF is quite close, tracking the CSI 300. And finally, we can find that recently our China 50 ETF works better compared with CSI 300 and also SSE 50 ETF benchmark. But generally speaking, our China AMC 50 ETF not work as much better as all the passive index fund. Now let's have a look. That's the second example ETF. I download this information from the Wind database. This is the industry index ETF. So this ETF is separate based on different industry, like a sector, as I mentioned before, the sector ETF. So we choose one of the hot topic recently is the cheap ETF. This cheap ETF earned lots of money on the first half of this year. So let's have a look at this graph. For the blue one is this Guangfa cheap ETF. And the red line is the National Securities Semiconductor Chip ETF benchmark, and the yellow one is our passive index fund. You can see from this graph, at the beginning of this year, from let's see, from the April of this year, the cheap ETF works much better compared with other passive index fund, especially recent 3 months, it earned lots of return for this cheap ETF. But I want to remind you, because it has more risk for this cheap ETF, so be careful, do not follow this one. So in this case, we don't want you to be a momentum investor to assume that this cheap ETF will continue to increase in the future. So we need to keep the risk in our mind. So I don't suggest to buy this cheap ETF now. Now let's have a look. This is the CSI Alcoholic Drink Index ETF. This is based on the alcohol. So let's have a look. In this Penghua mutual fund, they invest lots of money in Wuliangye, Guizhou Maotai, etc. Now let's have a look. This pink shadow area is the best 6 months return, which is from the first half of 2020, and the green shadow part is our worst 6 months return, which is the first half of this year. So compare with that, if you buy this ETF last year, and you will definitely earn lots of money. But in this year, if you buy it, definitely you will lose. Now recently, it has a sharp decrease in 2 weeks before. So definitely in recent period, the alcohol will give a mean reverting trend for all the price. So in recently, we suggest you don't doing any alcohol investment now, but today I think it will a little bit increase for all the alcohol. So I suggest recently you could not buy this ETF, alcoholic ETF, because there is a mean reverting trend. So it might be some volatile for this ETF's price. So that's all these 3 different ETF for you to understand. So in this lecture, we tell you what's the passive management portfolio and how can we construct a passive investment portfolio. What's the techniques like full replication, sampling, and quadratic optimization. And then we introduce 2 important passive investment portfolio like index mutual fund and also the ETFs. And finally, we show you some recently hot ETF in China's market to show you the performance for all these ETFs. So that's all for today's class. Thank you.